Welcome to The Explainer. Today, we're unpacking a massive, fascinating financial paradox, strategic wealth building on a 10,000 rupee salary. Now, usually we think wealth building requires, an abundance of capital, a massive six-figure income, or some huge inheritance. But our source material today dares to put wealth building and a highly constrained, modest income right next to each other. We're going to dig deep into the actual mechanics of how this works. And just to be clear, this isn't about generic feel-good motivation. No, it's about the literal financial architecture required to turn a tiny, recurring number into a massive, compounding asset. We'll explore the specific strategies, the modern investment vehicles, and the mathematical realities that make this seemingly impossible leap absolutely possible.
All right, Section 1, the 10,000 rupee challenge, framing the starting line.
10,000. Okay, before we can even talk about building wealth, we have to validate the real-world financial reality this number actually represents. In almost any economic context today, 10,000 rupees a month is a relentlessly tight budget. I mean, it's a number almost entirely consumed by basic, non-negotiable living expenses: rent, groceries, transit, utilities. Living on this amount usually triggers a constant survival mode, which effectively blocks out any mental space for investment. It is incredibly daunting. When inflation quietly eats away your purchasing power year after year, finding a financial surplus in 10,000 rupees, well, it feels mathematically impossible. But acknowledging this severe psychological and practical barrier is absolutely crucial. The source isn't ignoring the extreme difficulty of the starting line. Rather, it's explicitly making this precise constraint the absolute foundation of the entire wealth-building blueprint we're about to decode.
So, how do you actually build wealth on a constraint like this? If you're starting with 10,000, the math feels like a heavy headwind. The gap between your starting line and the finish line of actual wealth looks like a vast, uncrossable canyon. But as you'll see, the source outlines a bridge, and that bridge is built on precise, automated actions rather than drastic lifestyle overhauls. We aren't just talking about extreme, punishing frugality where you're hoarding pennies in a jar. Saving money just to hold it as cash actually loses you wealth over time because of inflation. Instead, we're talking about leveraging high-yield micro-investments and the rigorous application of percentage-based budgeting. Even a tiny surplus redirected intelligently into the markets completely alters your financial trajectory. The real secret here lies in decoupling the habit of investing from the initial size of the investment.
A 10,000 rupee salary establishes a strict baseline. When your income operates at this level, it honestly feels like every single rupee is spoken for before it even hits your bank account. Yet the entire premise we're analyzing requires a massive paradigm shift. It demands that you stop looking at this salary merely as a survival tool to be depleted every 30 days and start viewing it as seed capital. Treating a modest salary as seed capital means rigorously applying a percentage rule. If you can carve out just 10%, 1,000 rupees, boom, you've officially created an investment budget. That 1,000 isn't just money saved, it is capital deployed. By shifting the perspective from absolute, intimidating numbers to strict, manageable percentages, a modest salary suddenly possesses the core ingredient needed for wealth generation: a recurring surplus.
Moving right along to Section 2, Strategic Wealth Building, the Paradigm Shift.
10,000 rupees salary versus strategic wealth building. We've got the stark reality of a constrained salary on one side and the lofty ambition of wealth building on the other. This direct juxtaposition forces us to hold two seemingly contradictory ideas at the exact same time: the acute reality of limitation and the expansive reality of financial potential. Usually, traditional financial advice for low-income brackets centers entirely on debt avoidance and building a tiny emergency fund. But aiming straight for actual wealth building, that entirely changes the required mechanics. The bridge between these two extremes isn't found in suddenly earning more money overnight. It's found in the operational word connecting them: strategic. Strategic, relating to the identification of long-term aims and the means of achieving them. This is where we get into the actual core mechanics of the strategy. A well-executed strategy completely supersedes the scale of your current income. The primary means of achieving this is compound interest, accessed through systematic investment plans, or SIPs. When you deploy a small amount of capital systematically, say 1,000 rupees a month, into a broadly diversified index fund, you are purchasing assets that historically appreciate. You are basically buying a tiny slice of the broader economy's growth. Strategy involves utilizing time to do the heavy lifting that your initial capital simply cannot do. A microscopic monthly input, compounded at a standard market rate over 20 or 30 years, mathematically transforms into a staggering sum. The strategy is relentless consistency applied over decades, relying on exponential mathematical growth curves rather than sheer brute force saving power.
Wealth building. The goal remains massive and uncompromising. Notice it doesn't say getting by or saving for a rainy day. This uncompromising destination tells us that even if your starting capital is strictly limited, your ambition doesn't have to be downsized one bit. The destination remains identical to someone earning a six-figure salary. It's only the vehicle and the timeline that must adjust to the reality of the constraint. And the great news is, the vehicles for this are highly accessible today. Micro-savings apps, zero-fee brokerage accounts, and fractional shares allow you to participate in global wealth creation with incredibly low barriers to entry. You can literally buy into top-performing funds for the price of a cup of coffee. The timeline is simply stretched. You're trading volume for duration. The stock market doesn't care if your monthly contribution is 1,000 rupees or 100,000 rupees. The percentage of compounding works exactly the same way for everyone.
Let's dive into Section 3. Action. Investment on 10K, making it real.
$10,000 salary me investment. Translating to investment in a $10,000 salary, this exact phrasing takes the lofty financial theory we've been discussing and grounds it firmly in everyday reality. Using this colloquial, highly relatable phrase makes a technical financial strategy instantly accessible. It strips away all that intimidating jargon of Wall Street or high finance and places the power directly in the hands of the everyday earner. It's a culturally resonant acknowledgement that investing is not some luxury reserved just for the wealthy. It is a fundamental financial hygiene practice for absolutely everyone, regardless of their pay grade.
Deconstructing this excerpt gives us the precise blueprint for our wealth-building mechanics. First, we have the constraint, the 10,000. It confronts the reality head-on. Second, the context, me, or within this reality. And finally, the required action, investment. The required action is where the strategy is won or lost. To execute this, the source implies a sequence of strict, non-negotiable steps. It means treating your investment contribution as a fixed tax on yourself, applying the pay-yourself-first principle. Before rent, before groceries, before literally any discretionary spending, a predetermined percentage is automatically swept into an investment vehicle. Because if you wait until the end of the month to invest what's left over, the mathematical reality is that there will be nothing left. We all know how that goes. The action must be prioritized, automated, and entirely separated from your daily spending accounts to avoid the trap of willpower.
The act itself. What does this actually look like in practice? Let's put some concrete numbers to this strategy. Imagine setting up an automated, systematic investment plan for just 1,000 rupees a month, exactly 10% of that 10,000 rupees salary. If you consistently put that 1,000 rupees into a broad market mutual fund, averaging a historical 12% annual return, you aren't just saving 12,000 a year. In 10 years, you don't just have the 120,000 you put in. You have significantly more due to compounding. Stretch that horizon to 20 or 30 years, and the math just explodes. It's like a giant snowball rolling down a hill. Your initial capital input remains small, but the compounded interest multiplies that small input into millions. The act itself is about buying time in the market. The power doesn't lie in having a massive salary, the power lies in executing this automated action flawlessly, month after month, letting compound interest do the heavy lifting to absolutely defy the limitations of your starting point.
So, let me ask you, will you look at your 10,000 rupees differently now? It's not just a survival budget anymore, it's the starting line for your capital. If consistency and time can turn this extreme constraint into legitimate wealth, what could you achieve by starting your active investing habit today?